Hello, everyone. Welcome back to another episode of the Market Chat. Today, we have Jim Roppel as our guest. Jim is a hedge fund manager and founder of Roppel Capital Management and focuses on finding the next greatest opportunities in the stock market. Jim, welcome, and thanks so much for being on the show.
Richard, thanks for giving me a call and having me on.
Perfect. Well, why don't we get into it and start with your background? So could you tell us a bit about how you got into trading and how you adopted the CANSLIM system?
It happened very fortuitously in high school. My buddy had a Commodore 64 and he bought the stock and he was really into it, the market. I mean, I don't know how many shares he was buying, but through him, I then started watching the market in college. Two of my really close friends both were rabid market guys. I mean, it's funny that in college they were so into it, but one of them, unfortunately, from an inheritance, he inherited Paramount stock. And back in the day, because I'm a dinosaur, Paramount was a raging growth stock, and I didn't even really know what it was. But we both were buying options on that, and then the crash of '87 happened. Well, just before that, my roommate in senior year my roommate's father was a stockbroker. So I opened up an account with him with like $300 that I had to save forever because I think it was like 35 years ago. And so these two guys were my best friends. And then the crash of '87 happened and I was just riveted. And there was also a book called A Random Walk Down Wall Street. That I saw that book and I might be a counterintuitive person or just go against the grain kind of guy. But I saw that book and I said, look, somebody can do this. Not everyone's going to lose. There are going to be big winners. It's my opinion. And I read the book and I completely disagreed with it. And so maybe I just set out on a course to prove it wrong. And then I was hired on the first interview I had out of college as a cold call. It wasn't a penny stock place, but it was not a great operation. And then I worked there for about 3-6 months and I figured out what was really going on and talked to my dad's broker and he hired me. And then it kind of went on. But along this whole path, I was a loser. I don't really think I had a winning streak through any of it. And after a long period of trying all different sorts of methods, I saw the newspaper at a 7-Eleven and I read it and I loved it. Then I think I read the book and it just agreed with my nature. I'm not a value person. I like the interaction between the weather and the news and the innovation and the price action. So value investing, uncovering a book value of $100 a share and it's trading at 30 does not rock my world. Tesla today rocks my world.
For sure. And I think either it was in Arush's podcast, one of the many podcasts, but I think you said that you would build positions over time for your clients for over 9 months, and then the stock would just crash. So that's got to be very disheartening. How did you kind of keep that positive mindset and know you're going to succeed by doing this?
It could be another case of me proving someone wrong, like my wife who told me I was completely in the wrong business. I'm wasting my time, that I should be a lawyer or I should get another profession. And I'm like, no, I am not giving up on this. I can do this. I know I can do it. And Bill O'Neill really inspired me. I wasn't communicating one-on-one with him back then, but I believed I coach so well. Okay. If I have somebody who invests in me, I will do really, really well. And Bill, through his books and everything, I felt like he was investing in me. And then ultimately I got to talk to him a lot. And that really was a game changer. So
did you go to a lot of IBD meetups and his seminars and that thing?
When I first started doing this, Bill would speak for free. And
that's awesome.
And I went to tons of them. I went to, I would fly around the country to go see him. Often, 2-3 times a year. And that persisted for many, 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 many. I started in '87 as a licensed broker and that persisted until just a few years ago and I would still go to the master's programs and things like that, but I wasn't trying to see him 2 or 3 times a year anymore. I mean, I have notes handwritten that are this deep. And so I can just I have everyone recorded, every one of those ones presentations I went to is recorded, so I can just listen to them over and over again.
Mm-hmm.
But there's nothing like the live interaction with the market and then implementing the rules. Bill would come up with some new things occasionally, but his basic tenets worked 100 years ago. They worked when he taught them to me, and they still work today. And algorithms are not going to change that. Human emotions. Listen, if a stock's going to earn $1 this year and they're going to earn 15 next year, the stock's going higher unless we're in a cataclysmic bear market. Okay. So algorithms may distort the next 10 minutes, or maybe even, I don't know if they can do it for more than a day or two, but prices follow earnings. And that's never going to, human emotions, algorithms can't change that. They can, they want to steal a couple pennies from me while I'm trying to fill 100,000 shares. That saves me, because 20 years ago, I'd have to pay 50-cent spread. As far as I'm concerned, I'm grateful for the liquidity, although it has pulled out liquidity in times of distress. That was a little far afield.
No, that's fine.
You gotta keep me on mine.
I know. You told me. So apart from Bill's book, what are kind of your top 5 books for new traders, new growth style and traders?
Reminiscences of a stock operator, imperative. The earlier Market Wizards books, I think, are very exciting, telling you like what's possible, but also how they did it. I mean, the access that Schwager got back in the day was unbelievable. Darvis's book is a book you could read in a day and a half or two. You could probably get half of what is in O'Neill's book. It's a story. It's much easier to read. It's not a textbook. I think as I've gotten along later stages of this, I've realized that psychology is so important in it. And I just go see a shrink. I don't read the book. But getting a great book on psychology, I can't recommend anyone, but books are cheap. Shrinks are very expensive. What else? Perfect. Battle for Investment Survival, Loeb's book, amazing. If you just read those books and you implemented what you read unemotionally, the world is yours. With time, anybody who implements those rules with emotional control is just going to make money, period. If you don't, you're not following the rules, period. Or God forbid we get into a 10-year bear market, which we've never seen in history.
Perfect. Yeah, I think that's a great place to start. Darvis's How to Make $2 Million in Stocks. That was the first one I read. And I think I was hooked from the very start. Like you said, it was an easy read. I think I read it in 2 days. And his Darvis box theory, support and resistance, it still works. So perfect. Outside of trading, what do you think you have learned, or what passion of yours has translated the best over to trading? Like you said, psychology is a big part of it. You mentioned sports. So do you think having that mentality to be very coachable, analyzing tape, do you think that kind of helps, that kind of viewpoint?
Yes, absolutely. I think trading carries over into so many different things. I love to play cards. I love to play Texas Hold'em, statistical probability based on the first 3 cards you get. Golf teaches me how to react under pressure. I'm way better at it in the market than I am in golf. I mean, I'm a 9 handicap. Being in a marriage, something that humbles you. Golf, relationships, the market keep you in check. Performing under pressure is keeping your emotions in check. It's just so crazy difficult. And even after trying to get it right for 30 years, I am prone to doing things that I can't possibly believe I do. I mean, and more so in a market like this, I haven't done it much, but selling winners way too early is probably what a lot of people are doing right now. And a lot of people are trying to pick junk, I think. So following the rules, it sounds so easy, but it's so hard.
For sure. And what do you think about all these people chasing the knockdown, laggard airline stocks, the bankrupt stocks. What do you think about that? It doesn't affect the market too much because the overall capital is very, very small. But yeah, what's kind of your take on all of that speculation?
If there's not a cure for a virus, those people are being passed up by these amazing opportunities we're seeing. It's critical to understand the dynamics, how the world has changed in just a brief period has created unbelievable opportunities in just a handful of stocks.
Mm-hmm.
So while you're monkeying around with Royal Caribbean or these junk airlines that may or may not even exist,
mm-hmm.
Now, if there's a cure for the virus, those stocks are going to go to Pluto. The world goes back to normal. Well, kind of to normal.
Mm-hmm.
I mean, I don't really believe that people are going back to offices when they're much more productive in their homes and much more happy. So the world changed for the better because of this virus. But without that, these stocks are going to languish while these other companies, which have innovated and were already in good trends, have accelerated so dramatically. The money that can be made here and has been made, it's a complete waste of time. Why would you monkey with that stuff? It's
for sure. I completely agree.
It is a measure of exuberance or over exuberance.
Mm-hmm.
So it is a measure of speculation, maybe getting a tiny bit elevated. So I watch it for that, but I see no reason to fool around with that stuff. Mm-hmm. Relative strength is where it's at.
Mm-hmm. Perfect. So now I kind of want to talk about a little bit about being a fund manager and also how you actually implement the system. So could you give a brief summary of kind of how long you've been managing money and what kind of funds you oversee and work with other managers to basically take care of?
I have 3 funds. I have a big cap fund and a small cap fund. And Eve, who may be a lot of people who are listening to this run that for me. When she started, small cap stocks kind of got very thin. The amount of great small cap names were not plentiful. And so I just said, look, you can cross over into the big cap. So the fund initial mandate was more small cap, but I said, look, there's not enough opportunities, just buy anything. Mm-hmm. And that's also because the issues out there have shrunk so dramatically because of private equity and just not private equity, but takeovers and buybacks. And there wasn't enough names. So she runs a small cap, I run the big cap, I risk manage her. And then I have a crypto fund with my buddy, Matt D'Souza. And by the way, crypto is looking very interesting to me. It's gone very quiet, which is generally precedes big moves up or down. It's gotten tight. The average true range has shrunk up. Mm-hmm. Patterns look very interesting to me. Tangent. So those are my 3 funds.
Perfect. How is crypto different? Because there's no earnings and sales to look at. So how do you decide which one to take and which one to be invested in?
Is
it all price action?
Well, yes. Although it's the critical issue to understand is that the whole market cap of all crypto combined, the junk and the great, is like half of Microsoft. Mm-hmm. So we're discussing a microcosm of the investable assets. It's very much like venture capital, and it's much, much higher risk. It's radically higher risk. It's hard to control your risk in assets that can move so dramatically in a day with as much illiquidity as there is. It's I would say somebody should have 10% of their money in crypto.
So why invest in it at all? Like, is it because there's incredible opportunity because of that volatility? Is that why you have a fund in crypto?
I mean, just imagine if you personally could buy 1/1,000,000th of the internet in 1980. Where would you be today? You'd be a multi-billionaire.
And be on a beach somewhere.
Yeah. And you can do that in crypto. Now, crypto may not scale. Crypto may not work. But if it does, it's just such an asymmetric trade. You put a couple 100,000 in, and that could easily be a couple million. And everybody is puking. All the emotional people who can't sit, and they're just on to the next hot thing. They were all jumping in when it was red hot. But now the impatient and the immature and the less savvy are either they've blown out and lost a lot of money, or they just can't sit and they're on to the next hot thing, whatever that might be. And that's exactly the way I like it. When I was a retail stockbroker, you'd have bad markets, and I'd get back then it was monthly statements. Nobody had online. They couldn't look at their balance every day. So their statements would go out and I'd get calls. Oh my God, I'm down. And they would be dollar cost averaging in, and I'd say, just relax. Next month they'd call again. Next month they'd be like, liquidate everything. And I'd get 3 calls like that in a couple days, and I'd be like, that's it. The market's going to bottom within days. I was retail for 15 years, and it just happened over and over and over. The rookies puke at the bottom. It never fails. And crypto's doing that. Crypto's already done that, but now it's gone dormant, which is really the kind of like the last step. If it's going to run, it's usually a period like this where it will bubble up when everyone's has their eye on something else.
Gotcha. Okay, so let's get into what makes a true market leader for you. So how would you define a true market leader, both fundamentally and also looking at the technicals?
I'll go back to a chart Bill O'Neill threw up on a screen, and it was eBay. Say there's 40 variables up there. I mean, the monster metrics: pre-tax sales growth, earnings growth, pre-tax margins, after-tax margins, estimates for the coming year, earnings beat in the last quarter. Those are your keys. But then you don't have to tear apart a balance sheet. You don't have to be an accountant to be an amazing stock picker. Composite rating 99 stock, a base, relative strength. Now, those are all the technical and fundamental variables, but then the fundamental story. Is it a baby powder food? Is it an additive that makes your child smarter? Well, if it's proven that it's going to make your child 5 points more intelligent on this intelligence scale, you'd be negligent not to get that for your child. Revolutions like we're seeing in stay-at-home stocks, you have got to understand the fundamental story. When I had Broadcom, I figured out how many people were using dial-up, where you would wait 2 or 3 minutes to download one page, the ESPN page. It could take you 2 minutes to download one page. And I saw cable and DSL and satellite, and I knew Broadcom had the chip for all 3. And I knew because I used it, everybody was going to high speed. I knew everyone was going there. And I just did the math. It was so easy to understand that. And so hiccups in the stock did not rattle me. You've got to have everything. A true TML has liquidity also. You can have an amazing story that's a little less liquid, but almost every stock that I've made a lot of money in was very liquid. So you got to have the story, the technicals, the fundamentals. It's got to be all there. Bill put up that chart at eBay. If it had 40 variables, it had 38 of them. Okay, just everything's got to check.
Perfect. And how do you define liquidity? Is there a particular dollar volume amount that you like to see? 20 million, 30 million?
I mean,
up or higher? Okay.
I don't ever want to be more than 5% of the daily volume of anything. So that rules out all but the top 100 stocks. You've got to have big institutions in there. I mean, simply, the answer, I won't really look at something that trades less than 100 million daily dollar volume a day. And I much prefer a bit, much greater than that. But put yourself in the shoes of a big fund manager. Forget me, I'm small potatoes. But if you're running $80 billion, how do you're not even going to look at something that doesn't trade a couple hundred million a day. And if even there, you're buying 50,000 a day, every day. If the institutions are not in there and some big seller comes in, there's nobody there to just say, I'll take it all. And that's where you get these flushes in these stocks. Institutional sponsorship, grossly underrated. True market leader must have multiple quality institutions. Every fund, every stock has some institutions, but who are they? What's their track record? If you don't know that, you're probably a short-term trader.
Gotcha. That's very helpful. Okay, so let's talk about the differences between managing a fund and being a retail buyer. Obviously, you just kind of touched on it. Dollar volume doesn't matter quite as much for someone like me versus you. It's super important. So yeah, what are kind of the major differences, and how would you trade differently if you were managing less money?
I would listen, size kills performance.
Mm-hmm.
When you have less money to manage, you can get in and you can get out and the market can barely see you.
Mm-hmm.
I have to sell anticipating. I know my own position is going to knock that stock down. So I have to sell 15%, sell 15%, sell 15%, as to where the average guy can go 1,000 shares, market sell, I'm out, on to the next thing. As to where I'm lugging around. It's just like an Olympic athlete with cinder blocks around his ankles. You cannot run. You can't lever up. Not that I'm looking to cowboy it up and lever up, but when you're running your own money and you're on, even if you have, say, $5 million, you double that up on margin, it's no big deal.
Mm-hmm.
You can get out. But when you're running 100 million and you try to get out 100% up, you need liquidity. It's a dramatic handicap to be running a fund. Anybody running smaller amounts of money should be running circles around me.
Mm-hmm.
So the thing is, most fund managers have a lot of experience. And so maybe it's easier that I might have many more years of running money, but it's a tremendous advantage to be running your own. You don't have to account to shareholders who don't understand a drawdown. They're like, what do you mean we're 20% off the high? Like you don't have to answer to anybody. Well, there's good and bad there. Okay. People who don't understand the market, who are in my fund, they just don't get it. And I have to kind of manage for them too, because I don't want to disappoint their expectations.
Gotcha.
When you're running your own money and you understand what you're doing, you understand the normal cycle of things. And maybe we're in a bear market and we're doing nothing for 9 months. We're all in cash and we're just playing golf, but people don't get that.
Perfect. And on a day-to-day basis, what are the go-to softwares and tools that you use?
Wanda. Wanda is a hyped up version of MarketSmith, and you don't need Wanda. If I wasn't using Wanda, I would use MarketSmith. I use my Jefferies institutional platform. It's very valuable to me. I do have a bunch of charts up here from eSignal, but those are almost more of a distraction. They make me flinch and do things I shouldn't do because there's a little jiggle in there. That's it. I mean, you don't have to have fancy software. Listen, I was running $150 million in the 90s using something called Daily Graphs Online, which has about 20% of the capabilities of MarketSmith. So if I could run 150 million, 20 years ago with a stripped down version of what you guys are all running, you don't need Wanda. Wanda's a luxury. It's really nice, but you don't need it. MarketSmith is all you need.
Cool. And now let's talk about how you actually get into a position, because like you said, you have to kind of move in stair steps. So are you only buying on the breakout, or are you accumulating as it moves up the right side of that base, that cup?
I would say that 80% of all my positions are initiated on a breakout. And occasionally after a really bad bear or just something I have tremendous conviction in, I will start to buy up the right side. And I just follow, my initial trade is almost always 10% immediately of my whole account. Now, occasionally, if I'm running it up, I'll back off and I want to see if there's somebody else. Like when I pull the order, if that thing starts to drift back, I know I'm the only guy there. I want to see at least multiple people in there buying it. So then I'll fill out that 10%. I mean, it's not worth having a position if it's not 10% of your account, because how often do you get a 100% winner? If you have 2% of your account in it, you went up 2%. No one cares. It doesn't move the needle. 10% position, 100% gainer, 10% of your valuation improvement in the account. That's somewhat significant. I like to run them up, really good ones. I like to get 18% right within a couple percent of the pivot, if possible. But again, That's through multiple orders. I
Mm-hmm.
never, ever establish an 18% position in one trade. Never. But if I had a small account, I might.
Mm-hmm.
Probably not even then. I would still test the market. I want the market
Mm-hmm.
to follow up behind me and prove that I'm right. I'm
Mm-hmm.
always waiting for the market to prove my gains and my buys and sells by following up in that direction further.
Cool. And if you have that 18% and a potential true market leader going into earnings, are you going in with the full position, or are you lining up a little bit beforehand?
It would depend on how I am doing for the year. I probably
Mm-hmm.
would not open a position the day before earnings at 18%.
Mm-hmm.
It's if you can, a bad earnings report or a disappointing response by the market is a 30% haircut, do the math. It's not worth it. I tend to, now on the other side of things, if you have a gap up, I'm willing to build an 18% position throughout the day one on up 20%, no problem. If there's
Mm-hmm.
thunderous volume and everything else checks out, I will get right in there and chase that thing up all day long.
Mm-hmm.
But
Perfect.
not before the earnings. I will certainly buy before earnings reports.
Mm-hmm.
One of the best trades I ever had was NVIDIA, and I hit it pretty darn hard, and I didn't even realize that earnings were that night. And it went my way, but I had the volume conviction behind me. I mean, the volume
Mm-hmm.
day of the earnings report was so dramatic. I just was like, my assistant Eve, my friend, my partner, the girl who runs my other fund, called. She's like, "Hey, blockhead, there's earnings tonight." And I go, "Well, I'm going to take the risk because somebody's in there gobbling this thing up." So
Somebody knows something.
I don't really believe in too much in insider information, but
Mm-hmm.
I think people had done their research.
Mm-hmm.
I don't believe
Mm-hmm.
I don't believe the CEO poked their guy in the foursome that Sunday morning and said, "Hey, load up on NVIDIA." I think
Mm-hmm.
somebody was doing some channel checks and some very good research.
Mm-hmm.
I don't believe a lot in insider trading. I know it occurs, but I think it's a very, very obscure, irrelevant part of our markets. I think our markets are fair and fairly well regulated.
So on a podcast I listened to you on, you said that by the time that the 2020 crash really happened, you were so hedged that you didn't really feel the gravity of it. What caused you to put on those hedges? Was an extension above the 50-day moving averages on the indexes? What kind of indicators were you looking at?
Exactly what you said. Extension above the 50-day. I think my account was up. It was up a lot, and I just didn't want to give a lot back. And you're dead right. My Eve was like, "Jim, this Corona, C19 is going to be a really big deal," and I didn't believe it.
Mm-hmm.
But I did hedge off, and so when it started to break really badly, I was in Mexico on spring break. They actually closed the border when I was there, but I didn't feel like I could see the numbers, but I wasn't losing money. So when I finally took those hedges off and I got smashed one day, I was like, "God, this is a disaster." You've got to lose money to feel the significance or the power. And the same thing for making money. When you can talk all you want, but until your account's ballooning, you don't get it. And
Mm-hmm.
I've got significant hedges on right now. Although I'm 130% approximately long in like 6 stocks. I'm short a ton of index calls, fairly deep in the money. And I have some short calls against other stocks I have. I actually sold some Tesla calls today because it's getting a little bit rich for historical precedent over the 50-day. But it is the number one stock in the number one group, and it's liquid. It's an institutional darling at this moment.
Mm-hmm.
It can go dramatically higher, especially in this crazy market where the Fed is pedal to the metal. I think the 21-day is the new 50-day. I used to consider the 21-day irrelevant because I think
Mm-hmm.
all I thought it would do was cause churn in my account. And I don't really I'm not a short-term trader, and 21-day moving average is really for someone who's short-term. But in this market, if I had to hold all the way down to the 50, I could suffer an enormous drawdown. So I'm watching the shorter MAs. I went on a tangent again.
No problem.
I also had a gain that was significant enough that I didn't want to give it all back. So in the
Mm-hmm.
spring, I was hedging there, kind of like right now. we could go dormant in this index right now for a month or 2 months, and that I would be just fine with that. It'd be so healthy. And I think because of that, we could go way, way higher. But on the other side of that, the Fed is so aggressive right now, and there's so many leaders, and the world has changed so dramatically under C19 that we could just continue to fly in innovation. Edge computing with FSLY. That stock, I would never start a position on a short little digestion like this, but I would most definitely add. And there's no reason, if Edge is as big as it may be, as I've been told, that stock is early. Get me back on track.
Yeah. So on the downside too, so mid-March, are you looking at how we're 20% below the 50-day moving average, and you're starting to really focus in on what your buys are going to be once we have that fall through day?
I always have my list of buys, but the damage was so enormous at the bottom. I more or less was not going to do anything with my hedge funds. But personally, for some family money, I made a kind of a list of stocks that I thought were just amazing. And I was looking at total number of new lows, breadth thrusts on the downside, just numerous indicators that put the call at 1.5, and just all these, the market was screaming that it was very close. And so my wife was in there in her personal account buying a lot of super high quality names that I thought I was very comfortable with holding, but I was also very comfortable buying more a bit lower, So I was buying over, say, a week or two, and every time it would get smashed down another couple thousand points, I'd buy more. And I thought it could go a lot lower too. So we still had significant cash on the sidelines. But as far as the hedge funds, I was just waiting for the turn, and it was well after the bottom that I finally started to get my act together because I was late. The leaders showed themselves very quickly, RS-wise, leading RS lines, and they were so dramatic that I don't think they, in my opinion, had legitimate long bases like Bill O'Neill would love to see. Bear markets cause cups. This was more like the V. The leaders just straight up. So I was late to the game. And gotcha. I had the list. I knew what all the names were, but I didn't see the pristine buy points that I wanted, which the market could care less what I think. So in the end, I was forced to hold my nose, get in there, buy what I thought were the leaders, sit through pullbacks, get stopped out to get positioned.
So that's another way where I have the advantage because I can easily put in my stop loss. I'll be executed right away if that small consolidation doesn't work right away, whereas you have to really kind of tip your toe back in the water over time to really make sure you're managing your risk.
You got to work when you're running, when you're trying to buy 10, $20 million worth of stock or whatever, 15, you've got to work around that position. You just can't buy it all at once. So you've got to work it in. It's going to back off. You're going to get stopped out of a little bit. It's a dramatic hindrance to run a fund, especially a concentrated fund. So I just have to work around it.
For sure. All right. So I'm curious about the signs behind you on your monitors. What are they and what are the stories behind them?
Well, there are things that some of them have kept me in the game. One says, I don't want to rattle you all, but one says, rules, not emotion, 357.
Stop losses.
Yeah. Now I've tightened it up a lot. I kind of think it's more like 345. If I can get out at those levels. The next one is patience and rules, not fear. And I think people, when the markets pulls back, it seems to be very abrupt. I mean, didn't we have a 7% pullback on a Thursday about 3 weeks ago?
Yeah, I think so.
You know how many people sold amazing stocks because they're like, my P&L management or trying to avoid volatility has caused more people to get out of amazing stocks and life-changing stocks have been given to us recently, and people have gotten shaken out of them. There's no reason to sell many stocks that day. I may have trimmed off just a couple percent of a few things that were ragged, but I didn't sell much that day. Another one is follow the volume, and follow the volume is not as relevant as when I taped it up there 15 years ago, because the Fed has changed the game. In the indexes, markets sell off on crazy fear-driven thunder volume, and then they levitate slowly back up on less than normal volume. So I consider volume in the lately, because of QE, we've seen some amazing volume come in on the upside in the indexes. But in the prior 10 years, markets have gone down on dramatic volume and gone up on less than dramatic volume. So relative strength and trend is trumped volume. I consider volume gravy or a added bonus, but not mandatory. It's a little bit of a adjustment. I still want that volume, but I'm not going to demand it if the price closes dead high. Mm-hmm. This one is really good because of earnings. It says volume explosion, gap up equals buy. And that's just institutions screaming. Zscaler had it recently. Twilio had it. I mean, a myriad of stocks have had it. But I used to dislike the quiet period between, or what the CEOs can say versus talking to analysts and dispersing information sporadically. So now I think the institutions, when they pile in there, they're showing their hand. Mm-hmm. I know they're going to be there supporting these stocks that I'm buying. Like, I'm still a fly in the spectrum compared to these giant, massive multi-billion-dollar funds. And I'm just a parasite piggybacking off of those guys. So when you see the volume, now it's an added bonus. I get right in there. And then the last one is regain of 50-day MA, explosive volume equals buy. You mm-hmm. asked me, do I buy? I said I buy 80% of my stocks on breakouts. I will buy, usually adding to stocks that I'm already in when they break the 50 and then they come ripping back up through them. And if there's like a big leader that I missed and the 50-day would ever catch up to the stock, which doesn't happen in this market, and it gets shaken below it and then it comes through, I'll go in there and buy some. I usually consider those more add points than starting initial points. Mm-hmm. So those are all, that's it. That's cool. All.
Perfect. So let's get into current stocks and also how you do your post analysis. So I'm curious, how often do you look back over your past trades, maybe over the past quarter or past 6 months? And I know you've talked about before, you have to answer to Eve every single weekend. So tell me a little bit about your post analysis kind of system.
I'm going to be really honest. I don't do it anywhere near the frequency I used to. I mean, I honestly, when I first started, I had this giant, massive binder, and every trade, I would print it out, put why I bought it, and put it in there. And as time's progressed, I have not done a post analysis in a couple of years. I mean, I do what I say, not what I do, because the learning you get from that it's worth it. You can't buy it. You can't buy that for $100,000, what you would learn in a weekend of going through your trades. And if you have too many trades to go through in one weekend in the last 6 months, you're trading way too much. But again, I do have the critique with Eve every weekend. And even sometimes if I make a major bogey, I might get an email interweek that she thinks I've gotten out of line. So the value of doing it is indispensable. You've got to do it, especially I should do it more. Maybe I've gotten lazy or my ego's big and I don't think I need to do it. I think this is probably a wake-up call. I do need to do it because it just makes you significantly better. You got to do it. You have to. You'll learn so much.
Mm-hmm. Yeah, you talk about getting shaken out of great stocks. I sold Okta, Dexcom, and DocuSign on the 27th of May. Didn't get back in. But looking back over my trades, that's my number one thing that I learned over the 6 months. Don't sell those great stocks. And I did get back into them on small pullbacks. So I think I'm getting better at that, hopefully. But that was one of my big takeaways. Also, focus on the leaders and don't overtrade. Those are my top 3 things I took away.
I did all those things for years. And the biggest regret is like a Dexcom or a Vertex or these whatever. Once you get in the initial position and you buy it perfectly off a great base and now you've got a great cushion, if you get shaken out without a violation of a 50-day or some rule violation, now you're looking at an extended stock that had a 1-day shake, and now you're going to gamble everything on getting in on a 2 weeks tight. Mm-hmm. You're going to get stopped. Most likely you will get stopped out. That's the crime, is losing your position in the monster. because of a one day. And dude, I've been doing this for like 30 years. I've done it hundreds of times. And now I've become a much, much better sitter because wine gets better with age. I mean, most people drink their wine within 2 weeks of purchase. I let them sit for 10. I still have '07 cabs. I'm sitting on, I have a lot. They're just like stocks. The great moves, the monster moves occur. How many stocks double in 3 months?
Very few.
How many people hold stocks more than 3 months?
Also very few.
They're doomed to failure. How about this? The probability of them getting a 100, 200% gainer, they're violating the statistical probability.
There are different systems where you can kind of compound those quick gains like Mark Minervini does. He shoots for a bunch of 10% gainers in a row versus going for you, which is more going for those when you've got 18% of your portfolio, going for those 100% gainers. So there's different ways to play this game, but I agree with you.
Unless he's trading in a qualified a tax-deferred account, he's going to give 38% to the federal government and 5 to 12, 13% to the Fed. So I don't want to give away half my gains. Plus, selling a stock that's going to go up 100 or 200%, up 10% is just, I don't want it. The less trading I do, the better. So you take a Dexcom and you sell it up 10%. And now you're going to get back into it later. You know what? Everyone's got to find a style that suits them intrinsically. That just aggravates me.
Gotcha.
I'm still holding ServiceNow from, it could be 2 years ago. I'm not even sure. And it's not the leading stock. Okay. It's not Fastly, but I'm way up on this thing. I've not paid any tax on it. It looks great. It's part of the digital future. It's relative strength. I'm not exactly sure what it is. It's not 99, but I'm very comfortable chilling with it. It's also my smallest position. But
so are you trying to extend your time frames actually to try to limit those taxes?
Absolutely. I know multiple people and groups of people who are certainly running smaller amounts of money and don't risk manage like I do. But the people I know who've made 40, 50% a year compounded out for 15 years. I know people are still holding MasterCard from 10, 15 years ago. The great fortunes in the world, look at Bill Gates. He didn't sell Microsoft, 2 years into his tenure as CEO because great money, monster wealth is created over time and not paying tax. Warren Buffett. The reason Warren Buffett has so much more money than I guess Bill O'Neill has is that Warren Buffett still hasn't paid many tax. He's still holding Coca-Cola from 40 years ago. Think about the compounding and tax implications. Yes, I'm absolutely extending my time horizons. I'm aware of the fact that if a stock's going to triple, it's going to take 18 months. Absolutely. I don't want to live on a razor's edge. Every stock that I just initiated, like Zscaler, I'm down 1% on the stuff I bought this morning. I got to watch it like a hawk. I don't want to live like that. It's no way to live. I want to enjoy my life and get really rich. I don't want to make 10%.
Gotcha. Cool. So let's see. Is there any more questions associated with that? Okay. So let's talk a little bit about market analysis. So we talked a little bit about extension for the 50-day. Could you talk about how you classify something as an uptrend versus a downtrend? Are you purely based off the IBD confirmed uptrend, or do you have your own different metrics?
The general market, I do look at distribution count, but I don't feel that the distribution count, I've seen distribution counts very high and leaders have not cracked yet. So it's a caution. And also, listen, the IBD operation has made me everything that I have. I'm completely a knockoff of them, but their distribution count was not functioning properly. It was functioning properly, but it didn't help you for 5 years in a row in 2013 through 18. It's helpful, but the real indicator is how are your stocks performing. It's very difficult for a great stock to defy a general market downtrend, and I don't want to do that. But I honestly, I keep the distribution count in the back of my head. And I do note it occasionally in my ride the wave plan, but the real indicator are how are the leading dozen stocks acting? Have they cracked? On also what's leading the market? I'm more interested in what the market parts are doing. If the market's going sideways and it's not doing well, but a few stocks have amazing relative strength and I can get in those if I'm fortunate enough to, you can still make quite a bit of money. If the market's going dead sideways and you have a company that earned $1 this year and is going to earn 15 next year, the market can go dead sideways all it wants because that stock's going higher. The relative strength will show.
Perfect. So why don't we talk about a couple of the current market leaders? Let me share my screen, and if there's any one in particular that you would like to talk about, that would be great. All right. Can you see my screen?
Sure can.
All right. So I've got a list of kind of my top performers over here. Why don't we pick one and we can kind of go through where you might have entered. I don't know if you do have positions in all of these, and kind of go through the price and volume analysis.
Why don't we just, because of the superstar nature of Tesla, why don't we go with that?
Let's do it. All right. What do you want? A daily, weekly, monthly? What do you want to start with?
Let's do a daily. Yeah. What is it? Okay. So right around May, I was, yeah, you can see multiple days in there where I was buying it, and probably got right where your arrow was right there. I probably got shaken out of a little bit. If you go back 4 days, there, right there, that's where I probably started my position.
Gotcha.
Probably got shaken out of a little bit about 4 days forward, where you see it breaking. You got a lot of fast moving averages in here.
Yeah, I had the 10 EMA, 21 EMA, 30 SMA, and 50. Let me hide a couple of them. And did you get rid of all of your position from the previous run up? Because I know you were in there.
I did. I sold all that, and honestly, Tesla is such a super stock. It's so rare that you would get a climax run, and then it reloads to another to be a true market leader once again. I got very fortunate with Tesla in how I got out of it. I did not handle it ideally perfect, but pretty darn good. But through that period where you just were showing where it broke out, I bought some. I got stopped out of a little bit of it. I probably bumped out a 10, 15% of it. And then I just kept building over, say, 8. If you go way forward several weeks, right, keep right there. Go back 5 days, a little bit more right there. I'm sure, I guarantee I added that day for sure. Basically, every time a stock has a digestion of more than a week or two, I will add 5 to 10% more shares on top of my, initial 10, 15, 18% position. And so that just the stock moving up, and Tesla's just picture perfect. It doesn't get much back. It was the number one stock in the number one group.
Exactly.
And how tight, look at how tight it, right where your arrow is, and right in there, look at how tight it got. And then it comes out of there the last, 4 or 5 days, its volume's just gone crazy. And this isn't short covering anymore. I mean, there is some for sure, but it's not like the short squeeze we saw late last year. This is pure buying, I believe. And, it goes beyond I know you want to talk about technicals about this chart, but the fundamentals of this company, between the battery technology and the autonomous driving, the whole thing, everything about it, their innovative CEO, I love that I love the way he goes against the grain. You want to be average, stay in the crowd. You want to be unique, take a step forward. You cannot be exceptional staying in the crowd. And he just says the rules are wrong. I'm changing the rules. I'm doing it different. And that's how you get innovation. And that's how you get a stock to act like this. And institutions believe it. Now we're getting a good bit extended here. I did sell some calls on 10% of my position. I would believe that this stock could gap open tomorrow morning again. This stock could go into a climax. I mean, this is a really good candidate for that. And we haven't seen a lot of that yet. And I think this market may end up that way. We may have several blow-offs here.
Mm-hmm. So what does this market remind you of? Is there a certain time in history that like there's a lot of stocks acting exactly like this, where you've got a whole bunch of leaders? I don't know. What is this most similar to?
It reminds me a lot of 99. We're starting to see 99 was a lot wilder, but this is just heating up. Remember, we're only 3 months into this. Okay. I mean, we just had a bear market 3 months ago, and the world has changed. Not like Y2K was a massive spending binge on top of the America starting to understand the internet. This is a revolution caused by digital transformation, augmented by Fed stimulus, and then C19 just ramping the acceleration in this whole cycle. So this is gotten a little bit crazy, like Dexcom and not Dexcom, DocuSign is pretty heated up and fastly, and Tesla's starting to get there. But to get into a period that is going to end like 2000 did, we can go. I mean, remember, I think the NASDAQ doubled in 3 months in 2000.
Wow.
Okay, cool. And the Fed was stimulative, but nothing. The world's never seen stimulus like this. What we could see, I don't know whether we digest for 2 or 3 months, 2 or 3 weeks, or we absolutely just go straight. If the Fed has overcooked this thing and they don't back off, stock prices of these transformational stocks can go radically higher. And I mean right now. So it begs the question, do we buy these very short, stubby bases like on Livongo and some of these other things like you're seeing today? I generally don't recommend it, but if I was ever to do it now, I would be doing it now. It just seems to be working. Now, the market did soften on last Thursday. It sold off late in the day. Mid-afternoon today, a lot of C19 stocks got weak. Teledoc, I think, might have closed down.
I think Teledoc was actually strong.
Teledoc was up 9. Zoom was even or down. ServiceNow was.
Zscaler was weak.
Zscaler was definitely weak.
Yeah.
Twilio backed off. It just was not a strong day. It was, I think, covered up by a lot of Tesla and Amazon buying. So there's definitely a case to be made for a digest. In the market, the indexes were slightly extended, but overbought, oversold oscillators are not greatly over. They're actually very neutral. So short term, we could get a digestion in the hyped up names that are NASDAQ names, while the S&P is kind of forming somewhat of a pennant. So we could see a cooling of NASDAQ while the S&P maybe comes on. So ultimately, the Fed is uber powerful. It is overwhelmingly dominant, and you have to stay with them. So
for sure.
I sure took that a long way from the Tesla
chart. No, it's fantastic. And what stood out to me, if I go to a 65-minute chart, look at this. There's nobody who wants to sell this thing. It gaps up, just goes quiet, gaps up, goes quiet. And then late today, we have this huge volume push for a really nice close. I love this formation. It really shouts out to me.
Yeah. I mean, that's a beautiful chart. I mean, oh my God, it's so tight and the volume bars are great. I strongly think this thing could gap up tomorrow morning significantly. It may gap up several days in a row. People will overdo it. There's the people who were buying this a long time ago who understood the fundamentals, and then the people who bought it right on the breakout are probably sitting or maybe even trimming a little here. But the Robinhood guys, this is like crypto a couple of years ago. It's like it can only go higher. And this stock can go meaningfully higher. It's got, forget valuation. You will, I laugh when I see reports come out about valuation on growth stocks. It's a joke. Valuation has nothing to do with psychology and the way people view the possibilities. Yes, they're overvalued, maybe by traditional metrics, but that doesn't mean they can't go radically higher. So I love it when I see downgrades on valuation. I don't even read the report. They're a joke to me.
Yeah. LVGO was downgraded, I think, and then it completely absorbed it and just shot up higher today. So it goes to show that it doesn't really matter for these growth stocks.
Spotify did the same thing.
Mm-hmm. Mm-hmm.
Well, I don't know how well it closed, but it was down $11. But we'll see where it is at the end of the week.
Mm-hmm. Mm-hmm. So one big thing that I've noticed in this market, I love the gap ups on huge volume like you were talking about. It just screams that institutions are willing to buy these stocks. And I'm looking for an entry here. I didn't buy today. I had some in here. I tried to buy it as it broke out here. Sold, I think, on this day. But yeah, I'm waiting for a definitive breakout on huge volume. Today it did close very weak. Yeah, but I love the power that's coming in here. You've got Twilio doing the same thing, Chegg doing the same thing, a whole bunch of these top growth names.
All those names. And by the way, I think I was buying and selling Zscaler these same days you were, at same time, same days, because I know I've been in it and I got out of it right where you pointed.
Mm-hmm.
I mean, I just bounced out of it. But the days you're pointing to right now, that's an unmistakable clue.
Yeah, it's got 22.6 million shares traded. Average 50 is 3.3. I mean, that's clear accumulation. And then does the same thing basically the next day.
Look, there's no lock, but the odds are stacked in our favor. And now when the odds are in my favor, I want to put the pedal to the metal. That's a little bit of I want to do that, but I'm concerned that we've had such a dramatically powerful up year. And I have a lot of gains to protect. So when I say you got to throw the book at it and put the pedal to the metal when you see action like that, I say that with some caution about the current environment we're in at this exact second.
Gotcha.
But when you see stocks do that, you just have to be watching them, and you've got to take a risk with them. In the end, you're always taking a risk with 3, 4, 5% of your money. You always have to risk. But when you see volume like that, that's an overwhelming clue. You've got to get in there.
Yeah. So what do you do if it has a huge gap up, but then it falls below your initial stop loss of 3, 4, 5%? Because Chegg here, it gapped up, and if you were a little bit later in the day, you might have gotten shaken out down in this consolidation period. So how do you handle something like that?
I just sell it out, and but it's worth the risk, because that's the type of action that can lead to a 100, 200% gainer in 9 months. Think about the odds. I'm willing to risk 3, 5% of my money to make 200 or 150 or 80%. I will take those odds every day. So yeah, if I buy it, even if I buy it right and I establish the position throughout the course of the day on the gap up, if a week later or a month later I'm down 3, 4%, I'm probably just going to blow it out.
Gotcha.
You have to take a risk.
Go ahead.
You have to take a risk, and there are no guarantees. There never are. But I mean, I know people personally who bought Fastly perfectly and couldn't hold it. And so you've got to take the risk.
And let's see, how important is the up-down volume ratio to you when you're looking at a potential position?
I've never seen a TML without up to down volume that at one point hasn't been well over 2.0. Wow. It's kind of like driving your car at 180 miles an hour. It's a Ferrari. It's like relative strength. TMLs are exclusively, uniquely going to have RS above 95. Up to down volume is going to be in excess of 2. I mean, Google, with this massive float a decade ago or more, had a 3.0 up to down volume. I think Baidu also did. I mean, that's unheard of to see a stock that has that kind of liquidity with an up to down volume in those levels. The higher the liquidity of a stock, the harder it is to really wind it up and get it to go. So when you see a super liquid name with an up to down volume at 3.0, well, first of all, you probably need to have been in it before that happens. But now you know the institutions are ravenous for this thing. It's a very important variable for me.
And are you focused at all in stocks like LVGO, where it has great sales growth, but maybe not the great earnings record of going back the past 3 years or something like that?
Yes, I have a lot. I have Teledoc. So I feel like I'm covered in this area, but Livongo is certainly worth owning. I almost bought some this morning, but I have so much stock on board in general right now. I'm very reluctant to buy at this minute. I felt compelled to buy Zscaler just because of the volume breadth. But you asked me about, what did you ask me about Livongo?
So when looking at a position, I know Bill would say there needs to be earnings, but do you take that into account more, or are you okay with just exceptional sales growth for newer issues?
I think we're in a rare moment where the market is not demanding earnings, but it will eventually. Amazon is I want to say almost a one-off. Everyone refers to, well, what about Amazon? What about Amazon? Well, Amazon is one of the most unique stocks the world's ever seen. I don't like to have more than 20% of my account in stocks that don't have earnings. And I am more than willing to miss most of these ones that go crazy that don't have earnings, because they generally will never have earnings. Earnings matter really a lot. And so if it doesn't have earnings, sales growth, I don't demand triple digit, but it has to be 50% or greater. Or I have to understand the fundamental story so well that I am very comfortable with. I don't like no earnings. I like earnings. And if it doesn't have it, triple digit sales growth or at least 50%. Be demanding. It's your money. Demand the very highest quality. You can buy anything. You can buy junk or buy the greatest. I don't know why people buy junk when there's all this great merchandise out there, because they're afraid of a new high, afraid of a high PE. Those things are, if a stock doesn't have a high PE, there's nothing special going on there. Now it is a measure of risk, but as a measure of success or a probability of success, higher PE stocks are more likely to go higher. Low PE stocks trade at a low PE because there's nothing special happening. There's no world-changing technology like Zoom.
Zoom had the highest PE ever, and it just doubled right in here. Just doubled. I think its PE was 2,000 or something crazy like that.
Value investors may have more stable gains, lower volatility, but they're going to have way lower performance, and they're never, ever going to catch a Commerce One or an Ascend Communications or an Amgen or a Tesla for that matter. They're automatically by default omitting all the leaders. Now it's very important to trade your personality. And if you're of that nature, then that's the way to go for you. But you've got to understand what you're giving up.
Gotcha. Let's see. Are there any other stocks on this list that you really think there's a good lesson in here? Maybe some that you're trading currently. I don't know how much you can say, or any that aren't on this list.
Can we look at Coupa?
Yeah, let's do it.
And let's look at a longer term chart, please.
Sure. Weekly or monthly?
Weekly. My wife's friend works here, and she told my wife about it. I think my wife bought it maybe within a couple of days of it coming public. But this stock was downgraded multiple times on valuation. And it had a better mousetrap. It's an amazing fundamental story. And is the green line the 200?
That's the 50-day right now. 50-week right now.
50 week. Okay. I just think, take a look at this chart. Look at the earnings growth, the fundamentals. This thing is a monster. And I remember even my wife's friend who works there said, well, I think it might go to 60. It's 287. The trend is the only thing that matters. Now I see you had a bear cup in October, November of 18. And then you had obviously the bad shake in through the panic we just came through. This thing's a monster. And valuation doesn't matter. And price targets don't matter. So I really like this stock a lot. I don't personally own it right now.
It's definitely been one of the leaders, though, coming out of this correction for sure. So like you said, let's go to Dexcom, because like you said, it wasn't the perfect base. It was pretty V-shaped, kind of ugly, very short. I actually did buy this. This is one of my first buys. I think on this day right here, bounced off the 50-day moving average, a nice closing range. I sold a little bit right here to trim, bought back in on the first bounce of the 50. So one thing I did want to ask you was, what stage bases are you most focused on? Are you only looking at stage 1 and stage 2, or will you go later stages?
I definitely will go later stages. I mean, some stocks have 13 bases. Now the risk is way, way, way higher, but the answer to that question is, how well do you understand what you're investing your money in? If you know the fundamentals rock solid and it comes out of another base that's fifth stage, eighth stage, you can go buy that stock. I mean, your downside is 3, 4, 5% if you're cutting your losses. I do understand the higher elevated risk with later stage bases, but you've got to have vision to understand what can happen. What are the possibilities? What can a monster do? If you don't understand that, you're going to add up the dollars and get out. So I want to be there after the bear market and get that cup and handle base that's created by the bear market. But after that, it becomes a battle for keeping your eyes on the true leaders, not the new bases that are just emerging, 9 months after the bottom. You want to stay with the true leaders. The stocks that are powerful off the lows are generally the ones that are going to persist through the whole move. They're going to be the cycle leader. Now, most cycles are going to last for a whole sector around 18 months, 9 months to 2 years. I think waste management was the longest ever. And I have all the stats over in the other room, but I'm willing to go later stage bases, but I also understand the probabilities.
For sure. All right. Is there any other stocks? I know we're getting a little bit later now, so I want to respect your time, but is there anything else you want to talk about with regards to charting?
I would get some of older charts, and I really like O'Neill's charts better than any others. And you can just study them and look at what they do and how far they can go. Now, you have to be willing to sit through some intermediate term corrections, and you probably want to trim off some of your position through that. I mean, I'm not advocating sitting through intermediate term corrections, but get some charts of the true leaders, Amgen, Cisco, Ascend Communications, Tesla. In the last 2 years, study the chart. And the similarities are there over and over and over and over again. And be willing, if you're going to make giant money, you must sit through digestions. I mean, down to the 50-day. Now, we're in a market that's so heated up, I think right now, no one could really take him down to the 50-day. But so the answer to the charts, just study the great ones. And you have to believe that you're going to get into them, and you will. And when you get them, handle them like a true market leader, and that's how you'll capture the money. If you don't believe it can happen, it will never happen. And if once in one, you've got to follow the rules, and that's how you'll stay with it for the long pull. Stocks have got to give you bad behavior. You cannot sell. The only offensive sell rule that I really have is a climax run. And that's a downfall for me because I end up taking a lot over the top. But I'm also in some of the big ones for the big moves. And I'm willing to go over the top on most of them to capture the monsters, the life changers.
Perfect. All right. So with that, I think that's a great place to wrap it up. Jim, do you have any closing remarks for traders who are just getting into it, maybe haven't captured those true market leaders just yet, but want a bit of motivation to really dive deep and practice and get good at this?
It's going to happen. You've got to believe it's going to happen. And if you're following the rules, you can get seriously rich. Anyone can do this. And don't believe that just because we go through a period of a down cycle, that it's never going to work. It's absolutely going to continue to work unless we kill capitalism. I mean, unless Bernie gets elected and he jams like Elizabeth Warren and all these crazy people in there, and kills the golden goose of capitalism, innovation is going to persist. It's human nature to innovate. They're going to come public, and the prices are going to make new highs. This cycle will not stop unless government kills it. So until that happens, stick to this system. It's worked for a couple hundred years. It will continue to work, and anybody can do it. So follow those charts and those fundamentals. Thank you for the opportunity to speak.
Oh, it was great having you. I learned a ton. I got a ton of notes right here. I look forward to rewatching this. Thank you guys, everybody, for watching this video. If you enjoyed it, please go ahead and leave a like down below and comment if you have any questions or concerns. And I'll see you guys in future videos.